Welcome all. So, in the process of learning about the capital budgeting techniques or the investment criteria in the capital budgeting, in the non-discounting criteria, now this is the last technique which we are going to discuss. And after this, after completing this discussion on the different discounting and non-discounting criteria, different techniques, after talking about this last one, we will discuss some problems and solve some problems which are relating to the capital budgeting, and then we will learn about that how if any situation comes up of evaluating any investment proposal, then how to deal with that, maybe whether it is by calculating the NPV, IRR, modified IRR, or maybe the say your benefit cost ratio, or maybe using the non-discounted discounting criteria like payback period method, or maybe the say your this one which is now the last method which is in the non-discounting criteria, and this is the last one is called as accounting or the average rate of return. So, when we will solve some problems, some problems, then you will be able to understand that how we can implement these different techniques, different methods, different criteria to solve these problems, or some of the say capital budgeting problems, or some problems relating to the capital expenditure. So, this is the last technique. Now we will be discussing it, and after that I will take you to the some problems. Accounting or average rate of return. This is after payback period. One in the non-discounting criteria, one was the payback period method, very popular, largely used, and this is a technique which is used in almost in any proposals, evaluation of any kind of proposals. And the second technique which is there available with all of us is the accounting or the average rate of return, right. This is the second technique, or this is a second method of say called as a non-discounted method for evaluating the capital investment proposals. So, this is what is the formula for calculating or using this? This is the formula which is called as average PAT divided by the average book value of investment. Average PAT, that is the average profit after tax. We take the average profit after tax. So, how we take the average profit after tax, that we will learn. We have to see that how many number of years say cash flows are forecasted, right. How many number of years, for example, we are going to say start a project today, or maybe in the current year in 2019, and 2019 is called as the investment year, and after that for the next 5 years the project will be working or will be giving us the cash inflows. So, it means we will be having the next say up to 5 years, the foreseeable period is the up to next 5 years, and we can say look forward that yes, the profit after tax will be known to us, projected profit after tax will be known to us, and the average investment will also be known to us, that is a discounted, you can call it as the say depreciated value of the investment. So, at the beginning of the year, what is the investment there, that will also be known to us, and we will be able to calculate and find out the average for this investment. So, in this case, when you try to say implement this accounting or the average rate of return, as we have seen in this model, that average profit after tax divided by the average book value of investment, that is in the beginning of the year, what is the value of the investment is there, after calculating the depreciation, whatever the value is left at the end of the year, one particular year, that becomes the investment in the beginning of the year. So, that investment we have to take, and normally we will understand that if any investment we are making in the fixed assets of any company or in any project, then we are applying the depreciation, because we are not adding any new asset now. Capital expenditure is taking place only in the current period, that is in the 0 year. So, it means if we are investing any amount, for example, we talk about that we are investing 100 rupees in any project, right, and the depreciation rate is how much, 10%. So, what will happen next year, and we are charging the depreciation as per the SLM, straight line method. So, it means this amount 10% becomes 10. So, it means this amount will come down to 90, next year it will come down to 80, this next year it will come down to 70. So, it means it is 90, 80, 70 and 100, and then you this is the outflow and this is the investment. So, you can say that this is the 90, 80, 70, then it will come down to 60. So, it means over the years this investment is going down. This investment will increase if you make further capital expenditure, but that we are assuming under this method that no further capital expenditure we are making, maximum expenditure we are making here is 100, and we will be using this 100 rupees. So, naturally say this investment is made by way of capital and converted into fixed assets. So, when fixed assets will be depreciated, their value will come down. So, in the beginning of the 0 year, this is the investment, in the beginning of first year, this is the investment, in the beginning of the second year, this is the investment, in the beginning of the third year, this is the investment, in the beginning of the fourth year, this is the investment. And if you talk one more here, then say this is the total, we are left with how many 4 years after the say investment year. So, it means total number of years is 5, and you have to take this plus this plus this plus this, means these values, we have to take these values and divide it by number 5. So, it means you can easily calculate the average investment by taking the investment at the beginning of the year. So, same thing we are talking about here is that we are showing here investment at the beginning of the year is how much, that is 100 rupees or 100 crores. After depreciation next year it has come down to 80, then it has come down to 65, then it has come down to 53.75, then it has come down to 45.31. So, this way this investment is depreciating, but we are going to take the average of this investment. So, average of these how many 5 values we are going to take. So, what you are going to do, this plus this plus this plus this plus this and divided by 5. So, that will be called as the average investment, and then we have calculated the PAT for the year 1 and year this 2, 3, 4 and 5. This PAT is available. So, if you divide this PAT by 5, so what will be there? You can calculate the average PAT, right. So, we have to take it like this is a requirement of the model, average profit after tax, average book value of investment, but the investment in the beginning of the year. So, now we have got this information for a project that is called as the Mohan's Enterprises capital project, and here we have got the years, we have got the book value of investment, we have got the profit after tax, right. And now what we are calculating here, that is called as the average or the accounting rate of return. How it has been calculated? Accounting rate of return is calculated here, that we have taken the PAT in the numerator and we are summing it up the 5 values, dividing it by 5, and then we are talking about the say information given here, and then we are summing it up, dividing it by 5, and then we are calculating some percentage rate. In this case it has come up as 28.31%. 28.31% is the average or the accounting rate of return available here from this project, right. So, very simple, means there is nothing complex about it. Complex part is only to forecast the cash flows and then to calculate the profits and then to calculate the investment, that is a complex part. So, this will all depend upon the detailed project feasibility report, because when any new project is taken up and this deciding or working out this amount of investment of 100 crores and then say the operations of the first year and the profit at the end of the first year, a profit at the end of the second year. So, for this entire process we have to prepare the projected financial statements. Until unless you prepare the profit and loss account for the first year, you cannot get the PAT. Until unless you prepare the profit and loss account for all the 5 years, you cannot say get the profit after tax. So, what we have to do is we have to prepare the projected income statement or projected profit and loss account. So, if the projected income statement is ready, but I tell you preparing the projected income statement is a $1 million question, is very complex job, and there we need the so many other kind of information. One information is the forecasting of sales. One important information is the forecasting of sales, because if we have the sales figure with us, for example, that we have identified that if we go for any investment proposal and we are able to sell for the first year say goods worth rupees 50 crores, right, goods worth rupees 50 crores, right. Second year that we are going to increase it to 60, then it is going to become 65, then it is going to become 70, then it is going to become 75. So, this growth rate can be worked out, and this is very very important, because this all depends upon the market and demand analysis. So, we need a detailed project feasibility report, and based upon the DPFR we will get this sales figure, and once you have got the sales figure, then we will start backtracking. And now, for example, when you are preparing the profit and loss account, right, here we are preparing the profit and loss account. So, what you do is we for example, you write here as the income statement. This is the income statement, and in this income statement what we write here is, that is the it has 2 parts. One part is called as trading account, trading and profit and loss account, right. So, here we are going to prepare the profit and loss account like this. This is called as the particulars, and this is the amount, this is particulars, and this is amount, right, and this is the debit side, this is the credit side, right. So, what we are going to do here is, now we are starting with the buy sales. So, if you have forecasted the sales, then this figure will be there, then we write here buy closing stock. If you have the closing stock figure, we will calculate here, and this will become the total amount, and this will give you the total productions value, and this side we need the information about the cost, that is the direct material, direct labor and the direct overheads, right. This cost will be available, and the difference of this will be called as 2 gross profit. So, you will calculate the first the gross profit, and then you will say take this statement forward, and when you take this statement forward, so how you do it? You prepare then the profit and loss account, and profit and loss account is means continuing the trading account. So, you will write here what? By gross profit, and then by indirect incomes, other indirect incomes you can call it as non operating incomes, you will keep on adding, something will become here, and then it will be called as 2 say indirect expenses or non operating expenses, right. So, this all expenses you will take here, and then it is a sales figure, finally means the closing revenue figure, you will total it up, you will close it, and then you will get here something that is the 2 net operating profit before tax PBT. This amount will come here, then it will come as 2 tax, it will come here, and then it will be called as the 2 profit, or you call it as, you will be able to find out here is, that is the 2 net operating profit after tax, right, and this will be the figure. For arriving at this figure, which we are taking here in this our case of the 14, 17.5, 21.12, 22.09 and 23.57, this will depend upon this so much of the analysis, and this analysis begins from where? This analysis begins from this sales figure, and getting the sales figure depends upon the market and demand analysis. If you do the proper market and demand analysis, then only the things can be taken care of, right. So, it means now in this whole case, when you try to find out, it looks very easy that implementing this method is very easy, that we have got on the one side the investment figure, on this side we have got the PAT figure, but look at getting this PAT figure and getting this investment figure is a very complex job, right. If we have this information available, then after that calculating the average rate of return is very easy, then it can be done, but getting this information is very complex. For that you need to have to prepare the total detailed project feasibility report, and once that DPFR is ready with us, then only you can apply this method, and finally you can calculate. In this case, for example, we have taken the 1/5 of the profit after tax, and then we have taken the 1/5 of the book value of investment, that is in the beginning of every year, and this is the total, is a rate we have worked out, which is called as the average or the accounting rate of return, and we have calculated in this case is 28.31%. Now, to take the decision, if you want to apply this method for say evaluating the capital investment proposal, to take this decision, what you have to do is you have to now compare it with the required rate of return. This is the expected rate of return, and then you have to compare it with the required rate of return, and required rate of return depends upon my cost of capital. So, if for example, the required rate of return is 35% or maybe 30% and available rate of return from this is 28.31%, we will reject the proposal, right. But if my required rate of return is for example 20% or 25% and available rate of return is from this is expected rate of return EROR, expected rate of return is 28.31%, then we will accept the proposal, because my requirement is 25% and it is available here, it is 28.31%. So, certainly I will go for it, and I will accept this proposal, and I will go for this capital expenditure, right. So, one rate is available, one we have to find out that what is our requirement, then we have to compare that available rate of return with the required rate of return, and finally we have to take the decision accordingly, right. So, this is a very simple method and depends upon the availability of the profit for the future number of years and the availability of the investment for the future number of years, right, and then taking the average PAT and then the average investment here. Now, we will compare it with the say discounted criteria. As compared to discounted criteria and as compared to payback period method, there are some points of comparison with the discounted criteria like NPV, IRR and the benefit cost ratio, and some points are here of the comparison with the non discounted criteria, means the other method, that is the payback period method. So, when you talk about the pros, merits of this method, it means it is very simple. Simple means once you have got the profit figures or the investment figures, after that calculating the average rate of return is very simple. Second thing is based on accounting information businessmen are familiar with, means it is based upon the accounting information businessmen are the familiar with. Everybody knows that what is the profit after tax, how to calculate the profit after tax and how to interpret the profit after tax, availability of the say profit after tax, how to interpret that. So, that can be easily found out, that can be easily evaluated. So, it means in this whole case you can easily apply this method. This is the second important merit. Third one is considers benefits over the entire life of the project. If we talk about the say payback period method, we have seen in the payback period method that we are talking about here is that we are taking the payback period method only is considering the cash flows for the period up to which this basic investment of the 100 crores is recovered. This is a cash outflow in the 0 year and till the time this investment is recovered. After that, how many or how much cash inflow is available from the project, we are least bothered about. So, we are only limited about that much amount of the cash flows which are sufficient for recovering the initial investment. We do not take the cash flows of the entire life of the project into consideration in the payback period method. But in the accounting rate of return, we take this into account and then we try to find out that yes, that the average rate of return depends upon the entire projected period of the project. We are not only limiting our analysis up to recovering the investment, we are taking it up to the total foreseeable period, and if the total foreseeable period is available for the information is available for the next 10 years, then we will calculate the investment, average investment for the 10 years and the average profit for the 10 years, and then we will calculate the say accounting rate of return. This is one important, means you can call it as improvement over the payback period, or maybe say other way around you call it as a limitation also, that you have to find out the cash flows for the total or the profit after tax for the total foreseeable period, whereas it is not the case in the payback period. There we are only finding out till the investment is recovered. Here in this case, what is the total foreseeable period? We are calculating the cash flows, profit after tax, investment, and then we are calculating the average or the accounting rate of return. So, these are three important merits or the important positive points of this particular method, and then we have the cons, means demerits of this particular method. That is why it is not very popular, because in the non discounted criteria most popular is the payback period method and remaining are the let us say discounted criteria, and there also two are very popular, NPV and IRR. Since there are some limitations of IRR which have been done away with the help of MIRR, but largely because IRR is in the percentage terms and NPV is also means having so many positive points. So, in the discounted criteria we largely use NPV or IRR, and in the non discounted criteria we use PBP, payback period method, but this method is also available, that is why we are discussing here. So, cons are based on accounting profits, not cash flows, right. So, we are calculating this, means average rate of return, we are calculating upon the accounting profit. Accounting profit, as I just explained it to you, how to calculate the accounting profit, and then by preparing the projected profit and loss account and balance sheet, we are preparing this. So, we are calculating this average rate of return, and we are not concerned about the cash flows largely, though we are indirectly concerned with the cash flows also, because with the help of this profit we can calculate the cash flows and then we can take the decisions, but largely if you do not have even the total cash flows, you do not have to work out, we can calculate the cash flows, but you do not have to work out the cash flows. Even by simply calculating the profit, you can say apply this method. This is a con. So, it means cash flow is a wider term and the profit is a say limited term, and here also one important limitation of the profit is that it is the only profit, whether it is a cash profit or it is a say non cash profit, that is not discussed here. Because when you calculate this profit, when you are calculating this net operating profit after tax, this net operating profit after tax is normally nominal in the value. This is the nominal in the value and this is not the real. Why it is nominal? Because when you talk about here this by sales, when we are calculating this sales figure is not only on cash. These sales when we are including in the trading and profit and loss account, not only the cash sales we are including, these are the total sales, and in this sales the part of the sales are on the credit also. So, it may be possible that 80% of the sales are on credit and only 20% of the sales are on cash, right. So, it means if 20% of sales are on the cash, it means whatever the profit you are working out here, this profit only 20% of the profit will be on cash. So, this is a major limitation because we are here depending upon something which is called as the accounting profit, and accounting profit itself has some inherent limitations, and when you talk about the cash flows, it is a different thing, it is the real thing. Cash flows are real, accounting profits are nominal. So, taking some decision on the basis of the accounting profits sometime may not be a wiser step. Then is the next one is does not take into account the time value of money. Does not take into account the time value of money, certainly because it is a non discounted criteria. Like payback period method, it does not take into account the time value of money, it does not take into account the time value of money. So, it is not means discounting the cash flows, whatever the profit we are calculating here, these profits are even to be discounted. We are not discounting these say profits. Number one, they are not cash flows, and second thing is they are only profits. So, we are not discounting these profits. Internally inconsistent, this is a very important point here as a limitation of this accounting rate of return. Why it is internally inconsistent? I now explain it to you that when you talk about this profit is the profit after tax, right, and here we are talking about is the investment, which is average book value of the investment, average book value of the investment. So, it means how can you interpret it? You are talking about the method says that it is the average profit after tax divided by the average book value of investment, right, average book value of investment. When you are talking about this average profit after tax, this average profit after tax is the profit now left only to whom? To the owners or that to the equity shareholders, that is to the that is available only. This profit is available to the providers of the funds called as equity shareholders. They are equity shareholders, right, they are equity shareholders. So, it means because when you calculate the profit in the profit and loss account here, you are subtracting two interest cost, to interest on loan. So, it means any kind of the borrowing, what is the cost of that borrowing, it has already been subtracted. After this subtraction we have got this profit. So, once you have already paid the amount due or the cost of the borrowed funds or the loan funds, it means after that whatever now the residual value left as a average PAT, that is only sufficient for the equity shareholders, right. But when you talk about the denominator here, this denominator as an investment, that includes the total funds coming from all the sources, whether the coming from the share capital or coming from the borrowings in the form of the loans from the financial institutions or in the form of the bonds and debentures issued to the different investors. So, this investment is the investment coming from all the sources, whereas this profit is the one which is only the now the residual profit left for the equity shareholders, for the internal say resource providers. So, it means sometime it is called as inconsistent, that the funds coming from total sources are dividing the residual profit available only to the equity shareholders, to the internal say owners of the firm. So, it means sometime it becomes inconsistent. Either it should be taken the total cash flow here, that is without paying the interest against this total investment, or then or we should make some change in the denominator, where you can do one thing, that you can only take the equity capital, not the borrowed capital, but that we are not doing. This we are taking as a total investment, because in the balance sheet when you are making investment into the land, right, then it is the plant and machinery, then it is the buildings. So, what are the investment you are making? That investment, for example, we are making here 1000, here it is 1000, here it is 500 rupees. This investment has come from both the sources, that is, one is the equity plus debt. There we are not segregating, that only equity capital will be invested here, and here this time this side you write here as share capital, and then you call it as the long term loans, and then you can call it as the debentures. So, this side becomes the total capital, this side becomes the total liabilities. So, these total funds are making these total assets, or say causing or requiring the investment in the total assets. So, it means when these total funds are involved for this side of the total assets, then here it is the same case, that average book value of this investment is sum total of all these three or sum total of all these, and then it is becomes a denominator, but in the numerator this is available only to the share capital providers, and this PAT is left only to the share capital providers. So, it means their claim has already been settled. So, why it is included in the denominator. So, that is why it is sometimes called as the inconsistent method, but still we have to take a broad idea of, say, calculating the accounting rate of return or the average rate of return, and largely even the accounting rate of return is calculated like this. So, it means we misuse this method sometimes, but because of so many limitations, because time value of money is also not there, it is internally inconsistent also, and takes the cash profit for the entire life of the project also, which may be sometime not possible to calculate the correct profits for the total life of the project. And then is too much weightage to the distant benefits, too much weightage to the distant benefits is given, and what is how it is to be talked about, too much benefit to the too much weightage to the distant benefits. I will explain it to you here. For example, you look at these two projects, this is the project A and this is the project B, right. Now, if you look at here, the values, sum total of these values is same. If you take the sum total of these two values, it is same, it is also 1 lakh, it is also 1 lakh. Investment required, cash outflow required for the two projects is same in the 0 year, 1 lakh rupees, 1 lakh rupees, and then we calculate here the cash flows coming, profit after tax, and then the cash flows coming. So, if you take here into account, we are again getting the total amount is how much? Total amount becomes again 2 lakhs in both the cases. This is the 2 lakhs and this is also 2 lakhs, in both the cases it is 2 lakh rupees. But in this case, if you talk about the project A, here it is means within first 2 years the cash flows are very high, and here in this case, for example, if you talk about, we have to go up to for recovery of this amount of the say entire investment of this amount and this 2 lakh rupees, initially the cash flows are very less, and in the later years the cash flows are increasing. So, if you talk about the accounting rate of return, if it is a payback period method, we will only limit our analysis to up to first 2 years, because our investment is recovered in the first 2 years. But here, because here we are talking about taking the entire life. So, you can call it as per the time value of money. If you calculate the time value of money of this project, it will be much better as compared to this. So, it means we are saying both the projects are giving us the equal returns, because it is also giving us 2 lakh rupees, it is also giving us 2 lakh rupees, but here the profit and cash flows are coming at the distant years and it is coming in the beginning year. So, because it does not differentiate between the two, it does not differentiate that this project is better than this project. So, it takes means give the equal weightage to the cash flows coming either in the beginning or coming at the end or in the later years. So, that is another limitation of this, that though it takes into account the cash flows of all the years. For example, if we calculate the average rate of return of this and average rate of return of this, it will come as same, right. But here there is a $1 million question, large difference, because here the cash flows are coming in the later years, it is coming in the beginning years. So, any cash flow, any profit earned in much in the higher amount in the beginning years and lesser in the later years, that makes a difference, but in this method this difference is not taken into account, right. So, this is the one another important limitation, and last one is the no information about the target rate of return. No information about the target rate of return. So, it means we are only getting that from this project only 28.31% is available or expected to be available. What is our required rate of return? That we have to calculate separately, that is not given by this. For example, when you apply the NPV method, in the NPV method we say that we know the cost of capital, and when you discount the cash flows, cash inflows and cash outflows with the help of that cost of capital, you know that this project is ending up with the positive NPV, 0 NPV or negative NPV, right. In case of the internal rate of return, we are going to find out some rate of return which is available from that project, right. So, there is no point means say bothering about anything, but in this case we are not having any target rate of return. So, it means it is giving us only 28.31% and that too not based upon the cash flows, mind it, that too not based upon the cash flows, it is based upon the profit after tax. So, there is a difference in the cash flows and the profit, and since the target rate is not available, that how much target profit is there, we are not able to find out of it. So, it means this is another limitation, that now you have to calculate your cost of capital and then you have to find out that yes, my cost of capital is 25%, accounting rate of return is 28.31%, then yes, I can go for it, but otherwise I will not go for it. So, because of so many limitations associated to this method is there as one of the non-discounted criteria, and when the discounted criteria was not there, we were equally using it along with the payback period method, but now since very effective and logical and genuine discounted criteria are available, where NPV and IRR are the much better replacements of this method. So, we depend less on the accounting rate of return. In the non-discounted criteria we largely use the payback period method, and in the discounted criteria we use the NPV or the IRR method. So, as we do not use much the benefit cost ratio in the discounted criteria, similarly we do not use the accounting rate of return in the non-discounted criteria. So, with this I complete the discussion, conceptual discussion on all the 5 criteria. 3 methods are in the discounted criteria, 2 methods are in the non-discounted criteria. After having talked about all these 5 methods, we are now going to be clear about that how to evaluate the capital investment proposals, how to take decisions about the capital expenditure proposals, and how to decide whether to go for one particular say investment to be made anywhere in any case or not, and means whether we should accept that investment proposal, whether we should make that investment, we should not make that investment. By taking into account the time value of money, we can apply the discounted criteria, and just to have a rough idea about the recovery of the investment, we can apply the payback period method, right. So, this is the all about the different methods of the say investment criteria. Evaluation of the investment can be done. If you quickly want to take the idea about the recovery of investment, always use PBP, and then in say the detailed analysis we can use the discounted criteria. But I would tell you that normally we do not use either of the methods in isolation, we use this method together. Every project where we use the discounted criteria, we use the payback period method also. So, both the criteria go hand in hand, and if you ask me, then we can say 3 methods are more popular, NPV and IRR in the say discounted criteria, and the payback period method in the non-discounted criteria. So, this is something about the different methods in the say investment criteria. Now, we have to discuss some important points here, that in the practice which one of the methods are most popular or popularly used in India, that investment appraisal methods in the practice, which ones are there. So, this particular component and some problems with regard to the say some problems where we can learn about the evaluation of the capital expenditure, and say applying some methods that we discussed here, NPV, IRR, benefit cost ratio or accounting rate of return or PBP, how to apply them. We will do certain problems, some say practical problems, some sums, and then we will be clear about that if we have to evaluate any investment proposal, how we can do that. So, this particular part, investment appraisal in practice, and then some practical problems, I will discuss in the next 2-3 classes, and then I will close the discussion on this particular topic, that is the capital investment, say evaluating the or techniques of evaluating the capital investment proposals. Till then, thank you very much.